Hi there, and welcome to this Level 3 podcast focusing on costs and revenues. My name's Gareth. In fact, you can see my contact details there, garethjohn@fi.co.uk. More than happy to receive questions, whether it's about this subject or about your AAT studies in general. I'm a managing director with First Intuition, one of the UK's premier AAT colleges. We've been very pleased in recent years to do very well in some prestigious awards. We were awarded the UK Accountancy College of the Year in both 2010 and 2012. I was very proud to be awarded the UK Lecturer of the Year in 2011. More recently, we were nominated for the Study Resource of the Year in 2013. Now, the purpose of these podcasts is to really focus on some key problem areas that students often have in some of the major assessments through the AAT qualification. Since introducing the computer-based exams, the AAT have been able to gather a lot of very detailed data about which tasks students tend to find difficult. And really these podcasts are trying to focus in on some of those areas. So the area I'd like to focus on here for costs and revenues, which I'd argue is one of the two more challenging units at level 3 of the AAT. I think costs and revenues, along with the accounts preparation 1 paper, probably the two that students tend to find the most challenging. And one important area of costs and revenues is long-term decision making. You'll probably be aware that there is also an area of the syllabus covering short-term decision making, and that covers things like limiting factor analysis and break-even analysis. Now, they are important topics that you need to be competent with as well, but long-term decision making is looking at when we're making decisions that will affect a business for several years. Now, costs and revenues is essentially the key management accounting paper at level 3. Management accounting has various purposes, such as considering the costs in the business, for instance. Also has a lot to do with budgeting and planning in the business, but fundamentally it's about improving the quality of decisions made by the managers of the business. Management accounting is providing information for the managers. Now, as we've already said, some decisions are taken in the short term. This would include things like break-even analysis, limiting factor analysis. Short-term decision making tends to be where we're making decisions that will affect us over the next few weeks, but some are taken in the long term. This will affect us for several years, perhaps. Now, it's for long-term decisions such as perhaps whether to buy a new machine, because you could own a machine for several years, or buy a new vehicle, or even buy some property. If you buy property, you could own it for several decades. But a machine you may own for several years, and we use tools like payback period and net present value analysis. Although what we'll see that the different techniques we use are effectively forms of cost-benefit analysis. What we're ultimately doing is we're weighing up the costs of the investment, maybe the cost to buy the machine itself, against the benefits we will then enjoy by owning the machine. So hopefully owning the machine will help us to earn profits in the future. Well, let's have a look at a little example, and I'll show you how we can calculate both the payback period and the net present value of an investment. So we've got a business considering purchasing a machine for £50,000. Now that's really the cost of acquiring the machine. It's then going to generate cash inflows of £20,000 in year 1, so that's a benefit, £25,000 in year 2, another benefit, and £30,000 in year 3. Now we're going to be calculating both the payback period and the net present value of this decision. With the net present value, what we need to make sure we do is that we convert the cash flows into their present values. We're going to go through the process of discounting the cash flows. It's a concept referred to as the time value of money. Essentially, the longer you have to wait for a cash flow, the less it's really worth, because you've got to wait for it. And so what we'll be given in a task like this in the assessment is we'll be given what are called discount factors. So we're given a discount factor of 0.9090 for year 1, so that's if we've got to wait 1 year for a flow, 0.8264 for year 2, and 0.7513 for year 3. So if we've got to wait 3 years for a cash flow, you can see the discount factor is the lowest of the decimals. Because the basic idea is we're going to multiply the cash flows by these discount factors to convert the cash flow to true present value. However, we're going to calculate the payback period and the net present value here. And it's only with the net present value that we go through the process of discounting. Payback period will be based on the undiscounted basic cash flows. Well, this should be something you've hopefully seen already in your cost and revenue studies. And if you have, why don't you have a go at calculating? Well, why don't you start with a payback period? So maybe pause me for a few minutes while you calculate the payback period of this investment. Well, if I start with the payback period, different ways to set up your calculations here. Now in the assessment, they'll just be interested in your result. So you'd probably be looking to grab a spare piece of paper to do this kind of calculation. But what I would tend to do is I'd have a column for the year of the project, starting at time naught, which is the very beginning of the project. So that's kind of today. And for each year, we're going to look at the cash flow arising. So at time naught, you can see I've shown it as a negative figure because it's a cash outflow of 50,000 to acquire the machine. Then at the end of the first year, we get 20,000 inflow, so that's shown as a positive flow. Year 2, we get positive 25,000, and year 3, positive 30,000. Now, to work out the payback period, I think the easiest approach is to look at what's the cumulative cash flow as time progresses. The cumulative cash flow is just adding up the cash flows as you go along. So at time naught, we've invested 50,000. So literally on the first day of the project, you are 50,000 down as a cumulative cash flow. At the end of the first year, you then get 20,000 coming back in. Now that isn't going to pay back the whole 50,000, but it takes me, if I add back 20,000, it takes me to minus 30,000. So by the end of the first year, I haven't achieved payback. At the end of the second year, we get another 25,000. Now that's going to take me to minus 5. So it's still not quite paid back the original investment, which kind of makes sense because over the first 2 years, you can see we're receiving 45,000. So clearly it hasn't paid back the initial 50,000. And then in the third year, we get 30,000 back, which is going to clear the minus 5 and actually take me to positive 25,000 at that point. Now what you can see is that by the end of the second year, we hadn't paid back. And by the end of the third year, we've more than paid back. Now, when we're calculating payback periods, they would expect us to do it fairly precisely using number of months. I wouldn't say here that the payback period is 3 years, because the 30,000 that I'm receiving in year 3 isn't all going to be received at the end of the year. You can imagine that's not all going to be received on the 31st of December of that third year. If that 30,000 relates to sales I'm making, you can imagine some will be made in January, some will be made in February, throughout the entire year. And what we tend to assume in this kind of calculation is that the cash inflows are spread evenly over the year. So that 30,000 will be spread evenly over the 12 months of the third year. What I therefore need to do is prorata my calculation to work out fairly specifically, and we'd normally be doing it in years and months, work out fairly specifically what the payback period is. Well, we know it's 2 years plus something, because by the end of the second year we hadn't quite paid back. Well, what are we going to do as a prorating calculation? Well, the way I think of it is I still had 5,000 to pay back at the end of the second year. That's then being paid back out of 30,000 that I'm receiving during the third year. And what we'd actually do is then multiply that by 12 to convert our figure into months. So I think the payback period is going to be 2 years plus, well, if I do my calculation, 5,000 divided by 30,000 multiplied by 12 gives me pretty much bang on 2 months. So I think the payback period is going to be 2 years and 2 months. You can see it's not far into the third year because we only had 5,000 left to pay back, which is coming out of 30,000, which you can see is, it's a lot less than half of the amount we're receiving. So I think in answer to the first part of this task, payback period is 2 years and 2 months. Well, what about the net present value? Now, when we've done our payback period calculation, if you remember, we didn't adjust the cash inflows. These cash inflows were kept at 20,000, 25,000 and 30,000. In reality, they're not going to be worth that amount. The 20,000 I've actually got to wait a year for. The fact I've got to wait a year for it will reduce its value. The 25,000 I've got to wait 2 years for, even more of a delay. That will therefore reduce its value. And the 30,000 I've got to wait 3 years for. And this is where we now need to take account of our time value of money. We need to discount these cash flows. Well, if this is something you have already touched on in your studies, why don't you have a look back at the numbers in the example, and particularly you're going to now need to use the discount factors. Why don't you see if you can calculate the net present value of this decision? So pause me again for a few minutes while you have a go at that. Well, I can set up a working here, which is actually going to look fairly similar to the payback working. You can see we've got the years of the project here. From time 0, where we make the initial investment of 50,000, then 20 coming back at the end of the first year, then 25,000 in the second year, then 30,000 in the third year. What we're now going to do is to discount the cash flows by multiplying each by the discount factor. Now, we were given discount factors at year 1, year 2, year 3. We weren't given a discount factor at time 0 because that's always going to be 1. Because the flow at time 0 is today. That is in present value terms. And obviously, if you multiply 50,000 by 1, it stays as negative 50,000. That's already in present value terms. But what we should find is that the remaining cash flows are all going to fall. They're all going to be discounted because I've got to wait for each of them. That 20,000, for instance, if I've got to wait a year for it, it's not really going to be worth 20,000. If I multiply by the discount factor for year 1, 0.9090, I get a true present value of that figure of positive 18,180. You can see the way the value has fallen as we've discounted it. Then the 25,000 that I receive in the second year, that's not going to be worth 25,000. If I multiply by 0.8264, I think that's only actually worth 20,660 in present value terms. And the 30,000 in the third year, if I multiply by the appropriate discount factor, I get positive 22,539. You can see the way that each of the cash flows has been reduced in value as I've discounted it. And this really is where we now get our cost-benefit analysis. You can see you've got the cost of 50,000 in present value terms. You've got, in this case, 3 benefits for the present value of the cash inflows. And the net present value is literally just netting off that column. Literally just netting off this column to see, do the benefits outweigh the costs? So if you add down using minus 50,000, add on the 18,180, add on the 2660, add on the 22,539, I get an overall net present value of positive 11,379. And the fact that that's a positive NPV does imply that the benefits at present value do outweigh the cost. Therefore, this machine is worth buying. The general rule is if you get a positive NPV, you will accept the decision, you'll accept the investment. If it was negative, you would reject it.